This is your LMAX exchange technical update for Friday, March 31st, 2017. Euro dollar. So the other week we had highlighted the importance of the euro needing to establish above 108.75 and not just seeing a break above the level but a close above the level for confirmation of a bullish breakout that could expose a move up towards the 114 area. And so the market was unable to establish a daily close above 108.75, which kept the overall pressure on the downside and opened this latest sharp pullback that we're seeing back into the middle of a critical range between 109 above and 105 below. A break on either end now is going to be important in terms of determining the next big move in the euro. So if we push back above 109 here, we put in a higher low, and we push back above 109, it could then open the door for that major upside extension towards 114, confirming this inverse head and shoulders formation. But if we break down below 105, it will suggest a bearish continuation of the longer term downtrend, exposing an immediate retest of the 2017 low at 103.40. That's a 17-year low, below which would expose a drop down towards parity. Now, looking at where we're coming into right now as far as support goes, if you look at the move that we saw from the recent lows going back to early March all the way up to this high that we saw this month, just over 109, the 61.8% fib retracement and 78.6% fib retracement of this move comes in the 105.80 to 106.50 area. And so that level, this area right now is a critical level of support where the market should maybe find some support if it wants to put in a higher low and head higher over the coming sessions back towards those recent highs. This area between 105.80 and 106.50 is also important because it represents the Ichimoku cloud level, which defines whether the trend is going to be to the top side or to the downside. If the market's trading above this cloud, technically as a trend indicator, it lets you know that the market is trading in an uptrend. If the market breaks down below this cloud, then it's telling you that we're in a downtrend. So above the cloud uptrend, below the cloud downtrend. What's insightful about this analysis is that despite this pullback, as per the Ichimoku cloud, the market is still uptrending now after breaking out above the cloud back in the middle of March. And so again, setbacks, if they're going to be supported, should be supported into this 105.80 to 106.50 area, which also coincides with the Ichimoku cloud. A break below 105.80, the 78.6 fib retracement is very bearish, and that 78.6 fib retracement at 105.80 is also representative of the bottom of the cloud. So the key takeaway right now is that we're in the middle of this range now in the euro. We're back into the middle of this range. It's possible that we break above 109 from here and head significantly higher. It's also possible that we break down below the recent lows that we saw at 105, exposing the January 2017 low, that multi-year low. But if we are going to stay supported in this market, that level of support is going to come in right now over the coming session into the 105.80 to 106.50 area, where there's a lot of strong support, a confluence of strong support, which would make it ideal for the market to maybe put in a higher low here ahead of a bullish resumption. So don't rule out the possibility of a bullish resumption just yet, despite this intense decline. At the same time, be aware of the fact that if we do break down below that 105.80 area, it could open an acceleration below 105 and a more significant bearish resumption. So there's no clear directional insight right now, but there are some key things to look at which could help determine where this market may be headed over the short and medium term. Sterling dollar. So cable has pulled back off its recent highs, its attempt up above 126, and this market continues to adhere to a broader downtrend and has mostly been confined to a very well-defined consolidation over the past several months, roughly between 120 and 126. And so rallies up towards 126 have been very well capped and have been well capped once again in favor of what could be the next major downside extension in this market back towards the 2017 low from January at 1987, which guards against that October 2016 plus 30-year low at 118.40. At the same time, if the market does push through this resistance zone and manages to break back above the December 2016 high at 27.75, that will be a significant development, a significant bullish development, suggesting a structural shift in this market and a longer-term base that could open the door for a major move to the top side. So again, right now, selling rallies is the preferred strategy here as this market remains confined to a bearish consolidation in a very well-defined downtrend. But at the same time, if the market can establish back above 27.75, it changes the picture. Dollar yen. So dollar yen has seen a nice little bounce over the past several sessions after it managed to be supported ahead of critical psychological barrier at 110. But at the same time, the breakdown that we'd seen recently below a multi-week range support at 1160 does suggest that there could be deeper setbacks ahead. And so this rally that we're seeing right now should find a lower top somewhere ideally ahead of 114 in favor of that next downside extension below the recent lows that we saw just over 110 and towards a potential measured move at 107.60. At this point, I'd say a break back above recent highs that we saw around the 1290 area would be required to take the immediate pressure off the downside. But again, this still leaves open the possibility that the market can stall out for a lower top ahead of 114 and resume its down move towards 107.60. Ultimately, with this market, it would need to see a break back above 115.60 to force a structural shift, a bullish structural shift. Euro Swiss. So Euro Swiss has been confined to a well-defined downtrend, and this market looks to be on the verge of breaking down below that 2016 base at 106.24. But over the past several weeks, this has been a very hard level to break, and so we need to take it out to see that next major downside extension, which would expose a move down towards the 104 area. At this point, 108.26 is the level that you want to watch above. That's the key medium-term resistance, and it looks like that next lower top. And if we break above that level, that would be the only thing required to force a shift in the structure, or at least delay the bearish structure. Aussie Dollar. So Aussie has recently stalled out at a 2017 high at 77.50, which is significant because this is a market that's been very well capped towards 78 over the past several months. And so this latest pullback that we're seeing right now is expected to continue, with the market seen accelerating to the downside towards next key support at 74.92, that low that we saw in March from earlier this month. A break below that level would then expose a drop down towards the 70 handle. Any rallies that we do see should continue to be very well capped ahead of 78, with only a break back above 78 to really compromise the structure for Aussie dollar. Dollar CAD. Dollar CAD has seen some downside over the past several days and a bit of a consolidation, but overall this is a market that's been very well supported on dips, and so the risk here is for a higher low ahead of the next major upside extension below the multi-day peak at 35.99 and towards 140 further up. Any setbacks that we do see should be very well supported ahead of 130, and ideally this 132.64 low holds for that higher low ahead of that next major upside extension. Kiwi Dollar. So Kiwi is clearly pressured to the downside. This market has rallied up for a small correction recently, but rallies have been well capped up towards 70.90 and ahead of 71, and it looks like the market's ready to roll over again for a test of key medium-term support at 68.62, going back to December of 2016. A break below that level will accelerate declines down towards the 65 handle. SPX 500. The S&P 500 has been seeing a little bit of a correction this week after the market had reversed lower, taking out some key support at 23.50 last week, suggesting the onset of a meaningful correction. But we have seen this correction higher now extend back to the top side with the market into this key resistance zone. If the market can hold below 23.80, there is risk for a lower top and a continuation of this correction off the record high, with a breakdown below the 23.20 weekly low to accelerate declines below 2300 and down into the next sort of key measured move area around the 2280 area. At this point, though, if we do see a break and close back above 2380, it would suggest that the market is poised for a bullish resumption of this strong uptrend and a move towards fresh record highs beyond 2400, potentially up towards the 2485 area, which is a longer-term measured move extension. Gold. So gold remains highly constructive. This is a market that continues to show signs of a significant base after stalling out ahead of 1100 in 2016. We've since seen the formation of higher lows and higher highs, a higher low at 1180, a higher high at 1265, with the most recent pullback being supported around 1200 and a break above 1265 to confirm that next higher low around 1200 in favor of the next major upside extension towards a measured move in the 1330 area. Ideally, the market holds above 1200 now, but only a break back below 1180 would compromise the bullish structure for gold.